Your grocery receipt is hiding a money trail. Your paycheck may look the same, but your cart, your bills, and your plans start shrinking around it. By the end, you'll know where the money went. Not as a vague economic fog, but as a trail you can follow from the price tag to the receipt. Start with the grocery receipt in your hand. Same store, same routine, same feeling that you didn't buy anything extra. So why does the total at the bottom feel heavier than it should? That number is our first mystery, because it's where inflation stops being a headline and starts touching your life. Inflation is the speed at which prices rise across the whole economy, not just one item getting more expensive. A single price can jump because a sale ended, a shipment ran late, or one store changed its markup. Inflation is broader than that. Picture a simple basket of everyday things that costs exactly $100 today. If that same basket costs $108 one year later, the price level for that basket rose by $8. Compared with the original $100, that's 8% inflation. That percentage is the key. It doesn't mean every item rose by 8%. Some prices may rise more, some less, and some may even fall. But overall, the basket costs more, so each dollar covers a little less than it did before. Some weeks, inflation doesn't feel like a chart at all. It feels like standing in the checkout line, looking at the same cart you always buy, and wondering why the total suddenly looks wrong. Last year, your weekly grocery run was $60. Chicken, rice, eggs, milk, fruit, coffee, and a few snacks. Nothing fancy. Just the meals you already planned, the ones that get you through the week. Now you buy that same routine again. Same store, same habits, same dinners. But the screen says $75. You didn't add steak. You didn't double the snacks. You didn't suddenly start living bigger. The bill just moved. That extra $15 is why inflation feels personal. It doesn't arrive as one dramatic event. It arrives as a small shock on a receipt you thought you understood. And once you see it, the real question starts to bother you. If you bought the same meals, who actually got the extra $15? It didn't land in one pocket. Part of it went backward through the chain, to farms paying more for feed, fertilizer, fuel, and labor. Part went to truckers burning pricier diesel, processors paying higher wages, and stores covering bigger bills for rent, power, and spoilage. And part may have stayed as margin, because when shelves are tight and people still need dinner, sellers have more room to charge. The CPI doesn't show every hand that touched that $15, but it does capture the result at the checkout. Think of it as a giant shopping cart built to represent what households buy, not what one person buys on one Tuesday. Every item in that cart has a weight. Shelter carries a lot of weight because housing takes a large share of most budgets. A candy bar barely moves the index, even if its price jumps. That's why the headline inflation number can feel wrong to you. If your rent went up, your personal inflation may be higher. If you own your home outright and don't drive much, it may feel lower. The CPI is an average, not your diary. It blends millions of prices into one number, so it can describe the country while still missing the exact shape of your life. It shows the average, while the money trail underneath explains why it rose. Start by following that extra $15 into demand. When people want more cars, flights, meals, or homes than sellers can provide, businesses see lines, full bookings, and empty shelves. They raise prices because buyers are competing for the same limited stuff. Then broken supply makes the squeeze worse. A factory shuts down, a port backs up, a crop fails, or a shipment arrives late. Now there are even fewer goods on the shelf. Sellers don't need to cut deals anymore because the item is scarce. Next come higher input costs. If fuel, electricity, wages, packaging, or ingredients cost more, the seller's own bill gets bigger before you ever see the product. To protect profit, they pass part of that cost forward. The new price tag carries the higher cost inside it. Finally, Expectations can turn a price jump into a pattern. If businesses think costs will keep rising, they raise prices early. If workers expect higher prices, they ask for higher pay. Then businesses face higher costs again, and the chain keeps feeding itself. And while prices can move that quickly, your paycheck usually can't. Rent renews, bills reset, and store prices change long before your boss calls you in with a raise. That delay is where inflation becomes a quiet pay cut. Imagine you earn $4,000 a month. If the things you normally buy rise by 8%, keeping the same lifestyle now takes about $4,320. But your paycheck is still $4,000, so you're short $320 before you've done anything different. That doesn't always feel like one big hit. It shows up as smaller compromises. You delay replacing something, choose the cheaper plan, skip a repair, or let your card balance carry over because the month got tighter. Even if a raise comes later, it may only catch up to prices that already climbed. For months, sometimes years, you were paying new prices with old income. That lost buying power doesn't send you a bill, but it takes options off the table. For some people, inflation is a quiet loss. Picture a saver with $10,000 sitting in cash. The number on the bank statement still says $10,000, so it feels safe. But as prices rise, that same cash buys less than it did before. Now picture a borrower with a fixed mortgage. Their payment was locked in before prices climbed. If groceries, wages, and rents all move higher, but the mortgage payment stays the same, that debt starts to feel lighter in real terms. They still owe the same dollars, but those dollars aren't worth as much. Then there's the landlord. Their building may have been bought years ago with older costs and maybe an older loan. But once the market accepts higher prices, rent can be raised. The tenant feels the increase every month, while the landlord may collect more income without the same jump in old expenses. That's the hidden split. Inflation punishes people holding cash, helps some people who owe fixed debts, and can reward people who own assets that can charge more. It doesn't hit everyone evenly. It quietly moves buying power from one group to another. Now watch what happens when inflation compounds. Say you keep $10,000 in savings and prices rise 3% a year. After the first year, your account still says $10,000, but it only buys what $9,700 bought before. The damage doesn't move in a straight line. Each new year, prices rise from the new, higher level, not from the old starting point. So the loss stacks on top of the loss before it. After 10 years at 3% inflation, prices are about 34% higher than where they started. That means your $10,000 has the buying power of only $7,400 in the old dollars. The bank balance looks unchanged, but the real value has shrunk. That's a loss of roughly $25–60 in purchasing power without you buying a single thing. You didn't make one big mistake. Inflation made many small cuts, year after year, until the same money carried much less weight. When prices keep rising too fast, the central bank reaches for its main break: higher interest rates. It can't print more houses, oil, or workers, but it can make borrowing more expensive, so people and companies think twice before spending. That higher rate moves through the whole economy. Credit card balances cost more to carry, car payments jump, mortgages get harder to afford, and business loans become less attractive. A project that made sense with cheap money may not make sense anymore. As fewer people borrow and fewer companies expand, demand cools. Orders slow down, customers become pickier, and sellers lose some pricing power. They can't raise prices as easily when people start saying no. But this cure has a rough side. Before prices settle, businesses can feel the squeeze first. Sales weaken, debt payments rise, hiring pauses, and some workers lose hours or jobs. Higher rates fight inflation by slowing the economy, and slowing down can hurt before it heals. That's the final answer to the grocery receipt mystery. The extra money didn't buy you a better week, a fuller fridge, or more freedom. It bought the same life at a higher price, and that's why inflation feels so frustrating. The real cost is not just the number printed at the bottom of the receipt. It's the choice you no longer get to make. You swap the fresh fruit for the cheaper snack, skip the name brand, put one item back, or leave the store wondering what changed. Then the trade-offs move beyond groceries. The weekend trip waits. The car repair gets pushed back. The class you wanted to take, the savings goal you were proud of, the small comfort you used to say yes to, all start competing with bills that used to fit. That is why inflation is more than rising prices. It quietly takes options off the table before you notice they're gone. You don't always feel poorer all at once. You feel it as a string of smaller no's. Stable money does something powerful because it lets your plans survive contact with time. If the dollars you earn today can still buy what you expect tomorrow, your future hours stay yours. And that may be the deepest cost of inflation. It doesn't just spend your money, it spends the time you haven't lived yet. If this helped you see where your money is really going, hit like, subscribe, and keep following the trail with the next video.